Welcome back to the On the Money YouTube channel, powered by Allied Wealth. I'm your host, Ryan Wheelis. Thanks so much for joining us today. If you like the content we're putting out, please hit the like button down below. Give us a subscribe as well. We'll keep you updated on all the awesome content we hope to put out on the channel for your future. So today we're going to spend some time talking about an interesting topic called the truth and facts about mutual funds. So what is a mutual fund? Well, a mutual fund is a professionally managed pool of securities that basically works like this. You can buy stocks on your own, which is a good or bad thing to do, depending on if you know what you're doing or not, right? You buy the right stocks, maybe buy the wrong ones too. But to that end, you can also, instead of buying stocks on your own, you can put your money into a mutual fund. And when you do that, you get instant diversification across hundreds of stocks, and you get a professional money manager to boot. So, and the prospectus will spell out the strategy and the focus of what this manager is trying to do on your behalf. So, the benefits and drawbacks are easy diversification, professional management. You do have fees. You can have tax consequences via something called phantom income that you can't control. One thing to know about these as well is that NAV is calculated at market close, and structure can create challenges. This is probably the most important thing here. This NAV is calculated at market close. Why is that important? Well, the reason why it's important is this. Let's say that you just had a premonition something was going to happen, and on that day you picked up the phone and you called your advisor or your broker or whoever and said, "Hey, advisor, broker, sell all my mutual funds to cash at the market open. I got a bad feeling something's not going to happen good today, and I want to sell everything to cash right now." And that advisor will say, "Cool, no problem." Puts in their trade orders and uploads that to the market, and poof, your orders are out there. Okay. And let's say whatever happens, the market's bad. Let's say the market drops, 25% in a day, okay? Well, you're gonna get home that night, and you're gonna think to yourself, man, I did it. I saved myself a 25% loss. I had the premonition that this was happening. I acted on it, did good things. So you log into your account at TD Ameritrade, Charles Schwab, wherever you have your money, at Fidelity, and you look and you see, wait a minute. My portfolio is down. I had $1 million and I'm down 25% or $250,000, and I only got $750,000. What happened? I called my advisor, said, "Get me out of the markets this morning. What's going on?" Well, folks, one of the things about mutual funds is you can't get out of a mutual fund until the end of the market close. And at that time, around 3 o'clock every single day, the mutual funds recalculate their net asset values, and they honor any redemption requests at the end of the day. So you thought you were getting what's called intraday liquidity by making that move and getting out of the market that morning, but you really didn't. You can't get out of the mutual fund until close of the market. So what you thought you would accomplish, you actually didn't do because you weren't using the right vehicle. By the way, that's why ETFs, exchange traded funds, are slowly but surely coming around, and I believe will eventually replace mutual funds on a large scale. But that's a very important fact to know about mutual funds, all right? The next fact is what I call relative performance. And so what we have is a manager inside the mutual fund, and we're comparing his or her performance to the stock market. And we want the mutual fund managers who outperform the stock market every single year, all right? So in this case, we got to look at, I'm paying this manager to manage my money and get me more return in the stock market, right? Well, is it worth it? Okay, well, let's look at it. If the manager is up 15% one year while the market's up 10% one year, who won in this scenario, the manager or the stock market? And the answer is the manager won because they got 5% excess return over the stock market, and therefore they're worth the fees you're paying them, okay? The challenge is this, folks. We find ourselves wanting the mutual fund managers who beat the market every single year, right? Well, the answer to that question is maybe, and here's what I mean. Because if the market is down 40% one year, and your mutual fund manager is only down 30% that year, who won in that scenario? And the answer is the manager won. He or she beat the stock market by 10%. So the manager did their job. They won, all right? So the challenge of this is you lost. You lost 30% of the money you had in this mutual fund, okay? So you have to understand that mutual funds are relative performance. And what we want as consumers is we don't want to see this stuff, all right? But we don't realize that mutual fund managers are simply trying to beat the market on a relative basis. So it doesn't matter if it's up or down, they're trying to lose less in the down market and make more in an up market. Super important thing to know right here about relative performance on mutual funds. Another thing to know is Rule 35D1. Rule 35D1 is called the naming rule. And basically what it does is prohibits a registered investment company, which mutual fund companies are, by the way, from using a name that the commission finds by the rule to be material, deceptive, or misleading. So if you call yourself a growth fund, you got to be in growth stocks, right? And you must invest 80% of its assets in the type of security indicated by its name, again, called the naming rule. So for instance, if you look at the scenario, why does a typical mutual fund or 401k or mutual fund lose money during market declines? It's because of structures, because of this rule. So let's look at Fidelity Blue Chip Growth Fund right here, okay? Well, from the fund perspective, Fidelity Blue Chip Growth Fund is a growth fund, a mutual fund, and the fund normally invests at least 80% of its total assets in blue chip companies, okay? So it actually has to at all times. Now, this is super important, folks, because when this happens, right here in a system-wide market downturn, these funds are required to stay invested in their assigned asset classes, and therefore they have no choice but to participate in the loss. It's kind of like this. The mutual fund manager is not dumb. He or she sees the freight train barreling down them at on the tracks, but they can't get off the tracks because of that rule. They must stay invested with 80% of the fund's money in blue chip stocks at all times, which means you have $100,000 of money in that fund, and in a down year, this is the blue chip fund, by the way, and this was 0809, I believe, is the return here, down 38%. If you had $100,000 of money in that fund, the mutual fund manager could put $20,000 in cash. But the remaining 80% of your money is going to take the full brunt of that loss because of that naming rule requires that mutual fund manager to stay invested in that named stock with 80% of the fund's assets at all times. So folks, that's some pretty interesting stuff about mutual funds and mutual fund structures. I'm not saying there's anything wrong with mutual funds. There's great funds out there. There's not great funds out there. It's just super important to understand these things because I don't want you to be in a situation to where you didn't understand this stuff and you're in a situation where you lose money that you thought you couldn't because you thought you were doing things the right way. That's really confusing and can really hurt your confidence as an investor. We don't want that. We want you to be smart, confident, and wise when it comes to investing your capital here at Allied Wealth and On the Money. Folks, I hope you enjoyed this short video. Thanks so much for tuning into the channel. If you like the content we're putting out, please give us a like down below. Give us a subscribe as well. And if you leave any comments in the comment section, I'll be glad to return your comments or reply to your comments personally. Thanks so much for tuning in. We'll see you on the next video.